Hey everyone, stop what you're redoing and listen closely because the silver market just threw a curveball that could change everything. It's January 2026, and while the silver price is stuck around $90 an ounce, don't be fooled, that number is a trap. Behind the scenes, the London Bullion Market Association, LBMA, has gone offline, and dealers across the globe are freezing physical silver sales. This isn't just a glitch, it's a sign of a deeper crisis brewing in the silver market. Why does this matter? Because the 90 price you see on your screen doesn't reflect the real scarcity of physical silver. With the LBMA offline and dealers halting sales, the supply chain is breaking down, and the disconnect between paper silver and physical silver is growing wider by the day. This could lead to massive price shocks and leave many investors caught off guard. In this video, we'll break down what's really happening, why the $90 silver price is misleading, and what you need to know to protect yourself. Before we dive in, make sure to hit that subscribe button like this video and share it with your friends who need to hear this. And don't forget to drop your thoughts in the comments below. I want to hear what you think about this silver trap. The London Bullion Market Association, or LBMA, is a cornerstone of the global precious metals market, especially for silver and gold. Think of the LBMA as the central hub where the world's biggest players, banks, refiners, dealers, and investors come together to trade and set standards for physical silver. It's like the beating heart of the silver market, ensuring transparency, trust, and smooth operations. One of the LBMA's key roles is to oversee the Good Delivery System, which certifies the quality and authenticity of silver bars traded worldwide. This certification is crucial because it guarantees that the silver being bought and sold meets strict standards, giving buyers confidence that they're getting real, high-quality metal. The LBMA also facilitates the price discovery process for silver. While silver prices are influenced by futures markets like COMEX, the LBMA's trading and reporting help establish the benchmark prices used globally. This makes the LBMA a vital reference point for pricing physical silver. So, what happens when the LBMA goes offline? When the LBMA's systems or operations go dark, it disrupts this entire ecosystem. Without the LBMA's oversight and price reporting, the market loses a key source of transparency and trust. Traders and investors can no longer rely on the usual benchmarks to gauge silver's true value. This uncertainty can cause panic, reduce liquidity, and freeze trading activity. Moreover, the LBMA's offline status can delay or halt the settlement and delivery of physical silver, meaning buyers might not receive the metal they paid for on time. This creates a bottleneck in the supply chain, exacerbating shortages and driving up premiums on physical silver. In short, the LBMA going offline is a red flag, signaling serious trouble in the silver market. It shakes confidence, disrupts trading, and highlights the fragile balance between paper silver and physical silver. For investors, this means the $90 price you see might not tell the full story, and the real market could be far more volatile. At first glance, seeing silver priced at around $90 an ounce might make you think the market is stable or even cooling off. But here is the catch. That 90 figure is largely a paper price, a number driven by futures contracts and electronic trading, not the actual physical silver you can hold in your hand. And that's where the trap lies. The silver market is split into two worlds, the paper market and the physical market. The paper market includes futures contracts, ETFs, and other financial instruments that represent claims on silver, but don't necessarily correspond to real metal sitting in vaults. The physical market, on the other hand, deals with actual silver bars and coins that investors and industries need. The $90 price you see is mostly set by the paper market, which is heavily influenced by large banks and traders who often engage in short selling and price suppression tactics. These players can flood the market with paper contracts, creating the illusion of ample supply and keeping prices artificially low. This manipulation disconnects the paper price from the true scarcity of physical silver. Meanwhile, the physical market is telling a very different story. Due to supply shortages, increased demand from industrial users, and a surge in retail buying, especially in Asia, physical silver is becoming harder to find. Dealers are reporting rising premiums on silver coins and bars, sometimes well above the $90 paper price. In some places, physical silver is trading for $110, $120, or even more per ounce. This growing disconnect between paper and physical prices means that relying solely on the $90 figure is misleading. It masks the real pressure building in the market and lulls investors into a false sense of security. When physical silver is scarce and demand is high, prices tend to spike sharply, often catching many off guard. In essence, the $90 silver price is a trap because it doesn't reflect the true market realities. It's a number shaped by financial engineering, not by the actual availability of silver. For investors, understanding this gap is crucial to avoid being blindsided by sudden price surges and supply crises. One of the most alarming signs of stress in the silver market right now is that many dealers are halting or severely restricting sales of physical silver. This is in just a temporary pause it as a response to a deepening supply crisis that making it increasingly difficult to meet demand. So why are dealers freezing sales? The main reason is supply shortages. Mines around the world are struggling to keep up with demand due to declining ore grades, labor issues, and geopolitical disruptions. At the same time, the surge in demand from investors, industrial users, and governments, especially in Asia, is draining existing inventories at an unprecedented rate. Dealers simply don't have enough silver on hand to fulfill all orders. Another factor is the growing disconnect between paper silver prices and physical silver premiums. While the paper price hovers around $90, the actual cost to acquire physical silver is much higher. Dealers face a tough choice: sell at the lower paper price and take a loss, or raise premiums to reflect true scarcity. Many are choosing to limit sales rather than risk running out of stock or selling at a loss. For retail investors, this freeze is a major problem. Those looking to buy silver coins or bars to protect their wealth are finding fewer options and higher prices. Some dealers have introduced minimum order sizes or long waiting lists, effectively locking out smaller buyers. This creates frustration and fear among retail investors who worry they will miss out on the next big price surge. The freeze also signals a broader market panic. When dealers stop selling, it's a clear sign that the physical silver market is under severe strain. This can lead to even more buying frenzy as investors rush to secure metal before it becomes completely unavailable. In short, dealers freezing sales is a red flag that the silver market's physical supply is tightening dangerously. Retail investors need to be aware of these challenges and act wisely to protect their positions in this volatile environment. To fully understand why dealers are freezing sales and why the $90 silver price is misleading, we need to dive into the mechanics of the silver market, specifically how delivery demands, inventory shortages, and the futures market interact with physical silver. Silver trading happens in two main arenas: the futures market and the physical market. The futures market, like the COMEX exchange in New York, allows traders to buy and sell contracts that represent silver to be delivered at a future date. These contracts can be bought and sold multiple times before delivery, and many traders never actually take possession of physical silver. They just trade the paper contracts. However, some traders do choose to stand for delivery, meaning that they want the actual silver metal instead of cash settlement. When this happens, the exchange requires the seller to provide physical silver from the registered inventory, the stockpile of silver bars held in approved vaults that can fulfill delivery obligations. Here's where the problem arises. Registered inventories have been shrinking rapidly. As more traders demand physical delivery, the available silver in these vaults is being depleted. This shortage means that sellers may struggle to find enough metal to meet delivery demands, causing stress in the market. When delivery demands spike and inventories run low, it creates a bottleneck. Dealers and traders who rely on these inventories to fulfill orders find themselves short of physical silver. This shortage forces dealers to freeze sales or raise premiums sharply, as they can't risk selling metal they don't have. Meanwhile, the futures market continues to trade paper silver contracts, often at prices disconnected from the physical market. This disconnect widens the gap between the paper price and the physical price, confusing investors and creating opportunities for arbitrage, buying physical silver where it is cheaper and selling where it is more expensive. But because physical silver is heavy, costly to ship, and subject to regulatory controls, arbitrage can't fully close the gap. This leaves the market fractured, with paper prices suppressed and physical prices soaring. In summary, delivery demands and inventory shortages strain the physical silver supply, while the futures market's paper contracts keep prices artificially low. This imbalance is at the heart of the current market freeze and price disconnect, signaling a fragile system on the brink of upheaval. One of the most critical issues shaking the silver market today is the growing gap between futures prices and the actual availability and price of physical silver. This disconnect is confusing many investors and creating a volatile, unstable market environment. Futures prices are determined on exchanges like COMEX, where traders buy and sell contracts representing silver that will be delivered in the future. These contracts are often traded multiple times before delivery, and many investors never intend to take possession of the physical metal. This creates a large market of paper silver claims on silver rather than the metal itself. On the other hand, the physical silver market deals with actual bars and coins that investors, industries, and governments need. Physical silver must be mined, refined, stored, and transported, which involves real costs and logistical challenges. Right now, the futures market price for silver hovers around $90 per ounce, but the price for physical silver, especially in key markets like China and parts of Asia, is soaring well above that, sometimes reaching $120 or more per ounce. This price difference is known as the premium on physical silver. Ever wondered why the price of silver you see on your screen feels so disconnected from reality? Let's break down the growing gap between silver futures and the actual physical metal you can hold in your hand. This disconnect is a huge warning sign, and understanding why it exists is key to protecting your investments. First off, physical silver is getting scarce. Mines are producing less, stockpiles are shrinking, and demand from both industries and investors is skyrocketing. When something is this hard to find, its price naturally goes up. Second, the futures market, which sets those screen prices, is a whole different ballgame. It is heavily influenced by big financial institutions that often use tactics like short selling to push prices down. They flood the market with paper contracts, creating an artificial low that doesn't match the real-world supply and demand. Third, you might think someone would just buy cheap paper silver and sell expensive physical silver to close the gap. But moving large amounts of physical silver across borders is incredibly expensive and full of restrictions. This keeps the two markets from balancing each other out. This widening gap is a serious red flag. It tells us that the paper market is no longer a reliable indicator of silver's true value. If you're an investor relying only on those futures prices, you could be seriously misled. When this gap stretches too far, it can trigger sudden explosive price spikes, failures to deliver the actual metal, and chaos across the market. In short, the silver market is fragile and might be on the edge of a major shift. This growing turmoil in the silver market presents both big risks and unique opportunities for everyone, from individual collectors to large institutions. Knowing what these are can help you make much smarter decisions in this volatile climate. The risks are clear and immediate. For retail investors, the biggest danger is putting too much faith in paper silver, like ETFs or futures contracts. These might not actually be backed by physical metal. In a market where physical delivery is strained and inventories are low, you risk not being able to convert your paper investment into real silver when you need it most. You could end up with a cash settlement that's way below the soaring price of physical silver. Institutional investors, like banks and hedge funds, face similar problems, but on a much larger scale. If they have large, short positions, they could be forced to buy back in a market with no physical supply available. This could trigger a massive short squeeze, sending prices through the roof and causing a serious liquidity crisis. But on the opportunity side, this environment is a golden ticket for those who hold or acquire physical silver. As supply tightens and the premium for real metal grows, owning the tangible asset can protect your wealth and offer huge upside potential. That disconnect between paper and physical prices means if you buy physical silver now, you could see incredible gains as the market inevitably corrects itself. You can also diversify into related assets like gold, mining stocks, or other commodities that tend to do well when inflation is high and supplies are tight. So, while the silver market's instability is risky, it's also creating a rare chance for savvy investors to get ahead of a potential price explosion. The keys are to stay informed, focus on physical assets, and manage your risk. In a market like today's, where prices are all over the place and physical supply is tight, getting your hands on real silver is more important than ever. Here's some simple advice to help you navigate this and protect your investment. First, only buy physical silver from reputable dealers. Look for well-known trusted sources with transparent pricing and great customer reviews. If a deal seems too good to be true, it probably is. Physical silver comes in coins, bars, and rounds. So pick what works for your budget and how you plan to store it. Second, think carefully about storage. You can keep it at home in a high-quality safe, but make sure it's protected from theft or damage. Another option is to use professional vaulting services that specialize in precious metals. They offer insurance and top-notch security for your peace of mind. Third, act sooner rather than later. We're seeing some dealers freeze sales and premiums are rising. Waiting for a price dip might mean you miss your chance or end up paying even more later on. Buying now helps you get ahead of the rush before the market gets even tighter. Fourth, stay informed and be patient. The silver market is volatile. Don't panic during short-term dips. Focus on the long-term value of holding physical silver as a hedge against inflation and economic uncertainty. Finally, diversify. While silver is a fantastic asset, balancing your portfolio with other investments like gold, real estate, or inflation-protected securities can reduce your overall risk. By following these steps, careful buying, smart storage, timely action, and a long-term view, you can protect your wealth for whatever comes next. So let's wrap this up. The silver market is facing unprecedented challenges. That price you see on your screen, it's a trap. It doesn't reflect the real scarcity of physical silver. With major players like the LBMA going offline and dealers freezing sales, physical silver is getting harder to find, and premiums are soaring. This is a clear warning of a market on the brink of a major upheaval. If you're an investor, now is the time to act. Securing physical silver from trusted dealers and thinking about safe storage can protect your wealth from the coming storm. Waiting for prices to drop could mean missing out entirely. I want to hear from you. How are you navigating this silver market chaos? Drop your thoughts and questions in the comments below. If you found this video helpful, please give it a like, share it with your friends, and don't forget to subscribe for more insights. Thanks for watching, and stay tuned.